Dear students, I welcome you to my video lectures. I'm your course instructor, Dr. Mazullah Khan. In today's short video, I'll give you a quick recap of the pre-midterm course content, that whatever we covered before the pre-midterm. So we started with chapter number 10, and in chapter number 10, we covered about plant assets, natural resources, and intangible assets. So plant assets, sometimes we also call it property. We can also call it plant and equipment. And then another term that we use for plant assets is fixed assets. So plant assets are those assets which are not for sale. They are meant actually to generate revenues, but they are not meant for sale. So in chapter number 10, what we did, we learned about the accounting of plant assets expenditures. So there are two types of expenditures. One is called capital expenditure and the other one is revenue expenditure. So let's say if a company is trying to buy a new machine for their manufacturing concern, it's a capital expenditure. So in the first parts of the chapter, we learned about how does a company account for a plant asset. So when they purchase a machinery, how does the accounting entry look like? So for example, a typical entry would be if they buy, let's say, equipment. So you debit equipment, and let's say it's $50,000 equipment, and for example, they paid cash for it, so you credit $50,000. Another way of buying, let's say, plant equipment is, let's say, if you sign a notes payable for the company. So that is something that something really depends on whether the company paid cash for the purchase or whether they created a notes payable for that purpose. Once you acquire a plant asset, of course, plant assets depreciate over a period of time. All plant assets have a certain useful life. So depreciation is actually allocation of cost over a useful period of time. And there are different depreciation methods. The first method is called straight line method. The second one is called units of activity. And the third one is called declining balance. The straight line method, as the name suggests, it's a very straightforward method. So let's say if the useful life of this particular equipment is 5 years, and suppose the residual value of this equipment, or for the other word that we use for residual value is salvage value, is $5,000. So the useful life of this equipment is 5 years. So per year depreciation would be 50,000 minus 5,000 and divided by 5, which is 45K divided by 5, so 9,000. So this equipment will be depreciated $9,000 per year based on this straight line method. Units of activity, normally this method is used for machinery and for example vehicles. So every vehicle has a useful life. For example, a truck Sometimes larger trucks, they have a useful life of 2 million kilometers. So if the truck is driven, let's say, 10,000 kilometers in the first week, of course, you can apply depreciation based on the kilometers driven. Another way of calculating depreciation is declining balance, and the most common used method is called double declining balance. Once an asset is depreciated, of course, at the end of the useful life, the company sometimes disposes that plant asset. And the way you dispose it is either we sell it, so we dispose it through sale, or sometimes we retire it, and I'll tell you the difference, or exchange it. So sale, if we sell a plant asset, we either gain or lose money. And if we sell a plant asset, and let's say if we make any money, and the way we make money, for example, if the book value, the remaining book value, like net of depreciation, if it is like $20,000, and if we sell that asset for 25, of course we made $5,000. So we will record a gain on sale. But let's say if the same asset was sold for $15,000, of course it's a loss on sale. Retirement is actually disposing plant asset, let's say, and throwing it in the garbage. So you are retiring it. You do not sell it, or you do not exchange it. In fact, you just retire it. You just throw it away. And then another way of disposing of plant asset is, of course, if you exchange it for a different, like for example, exchanging one machinery for a different machinery. That's an exchange. In the last part of chapter number 10, we studied about accounting for natural resources and intangible assets. So plant assets, the cost allocation is called depreciation. But for natural resources, it's called depletion. So for example, if we have like any natural resource, for example, natural gas resources in Balochistan, or let's say in Sindh, or any other part of the country. So whenever we extract any natural resources from any particular reserve, that reserve depletes. So for plant assets, we use a term depreciation, and for natural resources, we use word depletion. In chapter number 10, which is current liabilities and payroll accounting, current liabilities are short-term liabilities. Short-term liabilities. And those liabilities the company needs to pay within 1 year. So within 1 year, or operating cycle. An operating cycle can be more than 1 year, whichever is longer, whichever is longer. So all those liabilities which are payable within 1 year or within the operating cycle, whichever is longer, those liabilities are called current liabilities. Current liabilities, of course, sometimes company need to make short-term borrowing. So for example, if they borrow some money from a bank, so whenever they borrow, you need to do accounting for that. And of course, all borrowings come with, let's say, some sort of like financing cost. So you do accounting for interest expense. Other forms of short-term liabilities are, let's say, unearned revenues. For example, let's say if Pakistan International Airlines, if they sell tickets in advance, let's say for month of August, those are unearned revenues because the company, in this case PIA, did not provide any services against those tickets. So this is unearned revenue, and unearned revenue is a liability. It will only be converted into revenues once PIA provides those services to passengers. Another current liability, type of current liability, is what we call contingent liability. So contingent liability are those liabilities which may or may not materialize. So for example, if a certain company is facing any litigation, so a customer or any government agencies or anybody went to the court and they are, let's say, claiming some damages from the company. The lawyer of the company, if he or she thinks that there are lots of chances of, let's say, losing this case, of course you have to take that into account and you have to show them in the books. But let's say if the lawyer thinks that there are remote chances of losing the case, then you have to provide a footnote in financial statements. You do not have to do any accounting for that. Once current liabilities are recorded and the interest expenses are also recorded in the books, of course, as a manager, you have to do some analysis. With this course, I'm not expecting you to be an accountant. As a business graduate, the purpose of this course is actually to understand accounting principles and how to use accounting information for managerial decision making. So as a business graduate, I'm not expecting you to be an accountant because normally companies hire chartered accountants, cost and management accountants, or any other professional with some professional certifications or degrees that hire those professionals for accounting. As a business graduate, you have to make some decisions, and you can use those accounting information for decision making. Another type of current liabilities is actually accounting for payroll. So payroll, of course, you need to pay your employees monthly or, let's say, bi-weekly salaries. And of course, some part of that goes to the government, like for example, employment insurance or other stuff. So you have to do accounting accordingly for that, for those headings. In chapter number 12, we covered topics regarding partnerships. So partnership, when two or more than two individuals, when they join hands together and they start a business, it's called a partnership. And partnership, one of the most important feature is that generally partnerships have unlimited liability. But there is another form of partnership which is called limited liability partnership. So in that type of partnership, one or more partners have limited liability, and that makes sense. So for example, let's say if somebody borrows money from you and that individual, let's say, borrows the money from you and tells you that, okay, if I make some money, I'll give you part of that income. So let's say if that particular business goes bankrupt, of course, the assets of that partnership will be liquidated and the creditors will be paid off. But of course, your liability is limited to your contribution towards the partnership only. So the creditors cannot come after you because your participation in that partnership was limited to the capital only portion of that partnership. So limited. Okay, so whenever an accounting entity is formed, of course we need to make some accounting entries. And mainly accounting for partnership tells you that how much each individual partner has contributed towards the partnership. So the first thing we need to do is create capital accounts for individual partners. In the second stage, of course, when a partnership makes some money, then of course you have to distribute that money among the partners. And this distribution is done through based on agreed formula. So it can be, for example, 50-50 partnership. So whatever the partnership makes, and let's say if the partnership has only 2 partners, then each partner gets 50% of the income. But of course, it can be anything. It can be even 40% and 60%, or let's say 30% and 70%. It really depends between agreement. It really depends on the agreement between the partners. And there are some situations where the partners think that, okay, this is the right time to actually sell the business, or let's say liquidate it. And this liquidation can be by, let's say, if a new admission of new partner, or withdrawal of a partner. So whenever the partnership is planning to admit a new partner, the first thing they need to do is actually to liquidate the partnership first and then form the partnership again. But of course, if one partner voluntarily or involuntarily withdraws from the partnership is also liquidated. In chapter number 13, we studied about corporations. So corporations are those organizations. It's a form of organization which has a separate. So I'll tell you some characteristics. So it has a separate legal existence. So it is separate from its owners. Liability is limited, so it has a limited liability. And the ownership can be easily transferable, so easy transfer of ownership. And how is the ownership transferred? Of course, all corporations, they issue stocks, and those stocks are traded on a stock market or capital market. So if somebody buys those stocks, they become owners, and vice versa. If somebody's selling those stocks, they're actually transferring their ownership to the new buyers. The other benefit of corporation is that actually they can acquire large sum of capitals. And where are they getting this capital from? Of course, they get it from the capital markets through bonds or common stock or preferred stock. Once a corporation act is formed, so the first stage was, of course, formation. So once a corporation is formed, they issue common and preferred stock. So Preferred stock is actually, it's like a hybrid security. It has some features of common stock, and it also has some features of bonds, which is a fixed income security. It's called preferred because they take preference over common stockholders. So let's say if a company is liquidated, preferred stockholders, they take preference over the common stockholders. So after the debt holders, preferred stockholders are the one who gets their money back first, and then the residual money goes to the common stockholders. They also take preference in terms of dividends. And so let's say if a company does not make any money in a certain year, and they did not pay any dividends to any common stock or preferred stockholders, most of the time preferred stockholders, their dividends are accumulated. So what they do, they get dividends for current year. So dividends for current year, and dividends which were accumulated in the past. So let's say if a company does not declare any dividends in this year, of course nobody gets any dividend. But in the next year, if they declare any dividend, of course the preferred stockholders, they get dividend for that year, and they also get the dividend that they missed for this year. Accounting for treasury stocks. So there is another form of stocks, it's called treasury stocks. And these are the stocks that the companies buy back. So buy back from the market. And the reason they buy back, like for example, let's say if Microsoft buy their own stocks from the market, those are called treasury stocks. And the reason they buy back, sometimes they pay those stocks to their employees as a performance bonus or anything else. At the end of this chapter, we also learned about how do we prepare shareholders' equity section. In chapter number 14, we discussed about dividends, retained earnings, and reporting of income. So for dividends, you have to keep in mind that there are three very important dates. One is called declaration date. The other one is called a recording date. And the last one is called payment date. On the declaration date, actually BOD only declares about the dividend, that okay, this company is declaring, let's say, $500 million as dividend. So this declaration, although it's like a legal obligation, we do not need to pass any entry because we did not pay any money to the stockholders yet. Then there is a recording date. On the recording date, what they do, they actually calculate the outstanding number of shares and calculate the dividend per share. So dividend per share. And of course, on the recording date, we do not pass any entry as well. We do not record any entry. On the payment date though, when the dividend is paid to the stockholders, of course the money is transferred to them, or let's say if it's a stock dividend, the stock is actually transferred to them. But of course, since the money has been transferred, then we will record that transaction in our books. In the end of this chapter, we also discussed about analysis of stockholders' equity. As I said like 5 minutes ago, this course is not intended to make you an accountant. You will only use accounting information for decision making. And in order to use those in accounting information, of course, we have to analyze those information. So for example, We learned about earning per share. So we calculate a ratio, let's say earning per share, or let's say return on equity, or anything else. So we analyze accounting information and then we use that information for decision making. That was it for today. In the post midterm, we will be doing lots of online lectures, and we will do it in two different ways. One, I will record lectures and upload them on YouTube, and I will share those links with you. So please watch those videos second by second. No skipping, please. So watch those videos second by second. Then I will also share PowerPoint slides with you. And please go to chapter number 10, 11, 12, 13, and 14. Skim through it, refresh your concepts. If you're struggling with anything, I'm just one call away. Drop me your question in WhatsApp group or maybe send me an email. This is the book that we are using, Accounting Principles. It's a very nice book, very well written. And of course, with each lecture, I will need your feedback. Feedback is really, really important. It really helps me fine-tune my lectures according to your learning needs. Of course, this is something new for me as a teacher, so I'm doing it for the first time. If you're struggling with anything, or let's say if you find an area where you think I can improve upon, please speak your mind. Tell me, and then I'll be happy to accommodate your suggestions in my next lectures. I thank you very much for your attention, and I'll see you in my next lecture. Have a wonderful day.